is a recession coming? The answer is almost certainly yes, with a footnote. The footnote is we may be in one already. We may be in a recession right now. Now, it's the case. You have to say, well, how do you know if you're in a recession or not? I mean, apart from the obvious, unemployment goes up and people lose their jobs and businesses shut down and growth slows. There are a lot of objective indicators of that. But there is a group of I call them the umpires, referees or whatever you want to call them, called the National Bureau of Economic Research. It's a private group of like egghead type economists up in Cambridge, Massachusetts, and they have the role of kind of declaring when recessions begin and when they end. They're not much use, and the reason I say that is because they wait for so much data that you're usually in the recession before they say, oh, a recession started in the fourth quarter of 2023. They might tell us that, by the way, like in the summer of 2024. Like, thanks a lot. We're 9 months into it. We're feeling all the consequences. Thanks for letting us know. But we kind of thought that at the time. So you don't have an official, party that rings a bell, or at least not in a timely way. If you want to forecast recessions or know when you're in one, you need to rely on your own research and, as much data as you can gather to figure that out. So, and the government, they say there's a rule of thumb definition, 2 consecutive quarters of declining GDP equals a recession. Well, there's always been a little more to it than that, including unemployment, which I mentioned earlier. But in fact, the United States had 2 consecutive quarters of declining GDP in Q1, Q2, 2022. We did. And nobody declared a recession. I look at it, it's like, hey, it looks like no, it's mild. It was over quickly. I'm not saying it was the Great Depression, but at least by that simple method, 2 consecutive quarters, we had a recession in the first half of 2022. Janet Yellen said it's not a recession, so I guess if she says so, that's supposed to be good enough for the rest of us. But and I don't want to dwell on that except to say that even that heuristic or metric seems to have gone by the board. So why do I say, in the absence of even simple rules of thumb or official guidance, why do I say we may be in a recession right now? First of all, the Federal Reserve Bank of Atlanta produces what they call the GDP Now indicator. It's computed a little differently than what Wall Street does. They sort of kind of do it on a rolling basis over the course of the quarter, and they update, about once a week. It's pretty accurate. None of them are perfect, but that they actually do a pretty good job. That showed growth in the third quarter of almost 5%, which is like red hot. In the fourth quarter, they're coming in around 1.2%. Of course, the quarter's not over. It won't be over till the end of December. And even then, we won't have official numbers until the end of January. So we don't actually know. But the history of the Atlanta Fed GDP indicator is that it tends to decline over the course of the quarter, kind of start out hot and then fade. So here we are in December. They're at 1.2%. Could they be, and they'll keep computing it in January because data, fourth quarter data keeps coming in even when you get into the first quarter of 2024. So could they show a decline in GDP when all is said and done? The answer is very possibly. And also, to the extent that they're good but not completely accurate, they could be overstating it a little bit. It looks like, so say, what other indicators am I looking at? It looks like the consumer just slammed on the brakes in October. And the consumer was the explanation for why the third quarter was so strong. People were just spending, I can't dissect the psychology of that, but they were shopping on Amazon, they were rock and rolling, they were buying things like crazy. Some of that was the residue or the carryover of fiscal policy from late 2020 into 2022. And here, I'm not talking about monetary policy. I'm not talking about Fed money printing. I'm not talking about interest rates. It's a whole separate subject. I'm talking about fiscal policy, which is government spending, and in particular deficit spending. But go back to the summer and winter of 2020, when Donald Trump was still president. He gave out, in 2 separate tranches, he gave out $2,000 to everybody in America. You didn't have to file a tax return or have a job or do anything. Just you got a $2,000 check. Well, two checks. It was like 1,400 and 600, but added up to $2,000. The last one in December 2020, just before Biden came in. Well, Biden comes in January 2021. He goes, I'm no slouch. I'll do it too. And Biden gave away $2,000 per citizen. Again, no questions asked. Everybody got a check in a couple tranches in January, February, March 2021. And remember the Payroll Protection Plan loans, PPP? That was $800 billion, so not that far from $1 trillion of loans to small business. Individuals are getting checks, but now small businesses, well, even large businesses for that matter, got checks. And you had to say, it was based on your payroll, and you had to say, I won't lay off more than a certain number of people or zero. And if you did that a year later and you gave us a certification, they forgave the loan. And better than that, usually when loans are forgiven, you have to pay income tax on the amount. They said, no, you don't have to pay income tax either. So it was a win-win. So that was 800 billion that was handed out. Then August 2021, Nancy Pelosi comes up with the Inflation Reduction Act, which had nothing to do with inflation, nothing to do with inflation reduction. It was basically the Green New Deal in sheep's clothing. But that was $1 trillion of spending. They somehow put John Podesta in charge of like $800 billion of Green New Scam money for whatever EVs, solar modules, windmills, all this other stuff that doesn't work. But so take that all together, almost $1 billion of payroll protection. Uh, sorry, almost $1 trillion. I misspoke. Almost $1 trillion for payroll protection, $1 trillion for the Green New Scam, $2,000 per person under Trump, $2,000 per person under Biden. It was an enormous policy. Oh, I forgot the Infrastructure Act that they passed. That was different from the Inflation Reduction Act. They passed that earlier in 2021, and that was $1 trillion. So just money flooding into the economy from everywhere. And then Biden put in grace periods for student loans, so you didn't have to pay back your student loans, et cetera. So that had a much more powerful stimulative effect than monetary policy. Maybe we'll talk about Fed policy later in the call, but the Fed's kind of impotent. They keep saying stimulus. The Fed doesn't stimulate anything, but fiscal policy does. When you're handing out checks, yeah, that has an impact. So now you come into 2023. We've had 3 years or 2.5 years, 2020, 2021, 2022, of spending. It also accounts partly for why inflation was so high, hit 9.1% in June 2022. And that operates with a lag. And there are some multiplier effects. I don't want to get into a Keynesian digression, but the impact doesn't all go away at once. So in 2023, we were almost surfing this wave of money, of fiscal policy that had been built up over the 3 prior years. And that was what was propelling the economy. Well, all of a sudden, it's like any wave, and if you're a surfer, waves run out, they flatten out. Well, that's what happened. By the middle of 2023, what happened? Savings were depleted. The student loan grace period was over. They said you got to start paying back your student loans. No more payroll protection plan. No more check handouts. No more pandemic handouts. The Inflation Reduction Act, I guess they handed out most of the money. And it was all this money that was being handed out, and it does produce stimulus, was gone. Suddenly it was gone. And then people kept spending. They were almost in the habit. So then they drew down their savings. They ran up their credit cards. They got big credit card balances. And credit cards, by the way, if you pay off your balance every month, good for you. But if you don't, those interest rates are 20% on the friendly cards and 30% on the nasty cards, but 20 to 30%. Well, if you have a balance and you pay the minimum and your interest rate, your interest is accruing at 20%, that will double the balance in a little over 3 years. So how are you going to get out of that hole? And so all these things came together at once. You pay back your student loans, no more handouts, no more loans, savings gone, credit cards, maxed out, and all of a sudden, boom, people just slammed on the brakes. And that happened around October. So that data is still kind of trickling in. We don't have all that data yet. Some of it's coming in, and it also takes time. All these things operate with a bit of a lag, but that's probably when the recession began. How bad is it going to get? There are a lot of signs out there. I mean, commercial real estate is collapsing. Um, Residential real estate is not collapsing, but no one's selling their homes because mortgage interest rates is still about 6%, but most people have like 3% mortgages. So why would you sell your house and refinance a 3% mortgage at 6%? You just stay where you are, and it's affordable. Um, Auto loans are going into default. Credit card balances are going to start to go into default. Those losses are going to go up. The banks are retrenching. There are some much more technical indicators. We don't necessarily have a lot of time to spend on them, but negative swap spreads, inverted yield curves, other signs come behind the curtain, if you will, of the Eurodollar system, which is really what drives the economy. It's not the Fed. It's not base money. It's not the so-called money printing. It's the banking system. It's commercial banks. Are they making loans? The answer is no. Are people borrowing? The answer is no. And that's all imploding in front of our eyes. All that data is there. So I would say that don't buy into the Wall Street narrative. There is no such thing as a soft landing. A soft landing is the early stage of a hard landing or a plane crash, if you will. But there are no soft landings. The Goldilocks scenario, this version, Goldilocks will get eaten by the bears. The data is very bad, very discouraging. It's happening very quickly. And so, yeah, and then that means the stock market is going to correct. People are euphoric over this. There has been a stock boom since last summer. I mean, you can see it in the charts. But I advise people to don't look at a 3-month chart. I know what happened the last 3 months. Look at a 2-year chart or a 3-year chart. And what you'll see is that NASDAQ peaked in November 2021. The S&P and the Dow peaked in January 2022. We're coming up on 2024. Now, as the stock market hasn't gone anywhere in over 2 years. Now, it's gone up and down. There's been volatility. I'm not saying you couldn't make money or, obviously lose money, but it just begins to look more and more like the 70s, where the stock market in 1982 was exactly where it was in 1969. That was 13 years where it didn't do anything. Now, it went down, it went up, there was volatility. I'm not saying you can't trade it. I'm saying that if you're the buy and hold investor, you not only didn't make anything for 13 years, but adjusted for inflation, it was down over 50%. So the 70s was a Great Depression style stock market collapse, particularly adjusted for inflation. Because remember, during the Great Depression, we had deflation. At least your money was worth more, even if people didn't have any money. Um, but here, when the stock indices are flat for 13 years, and you adjust for inflation and take away half the value, that means they were down by half in real terms. So it kind of feels a little bit like that. But before you get too euphoric about stocks, just remind yourself they've gone nowhere for over 2 years. And if we're peaking now because the stock market hasn't absorbed the recession analysis I just gave, then you're heading for a fall. So you can see a big stock market correction in 2024.
Yeah, it's an important thing for people to look at. You just mentioned, Jim, that you have to uh, go out a little bit more and not look at just the last few months, but to take it over a couple years and see what the market numbers actually were compared to just a few years ago. It hadn't moved
Right.
much. So, okay, you mentioned the Fed earlier. That's another question that a lot of the readers are interested in, is the Fed policy. And in fact, they're meeting today and tomorrow for their December FOMC meeting. How do you see Fed policy changing in 2024 based on economic indicators you see? And at this point, as you have said many times now, anymore, is Fed policy as important to look at than the economy as a whole?
Yeah, short answer to that is no. Now, look, we watch the Fed, we, monitor Jay Powell's press conferences, we read the FOMC releases, we look at money supply, we analyze it, we factor into our other analysis. So I'm not saying you shouldn't think about the Fed or we're not, because we do, and we have publications that are very much built around analysis of Fed policy. Having said that, the Fed is less important than it has been for a long time, almost irrelevant. And I saw this in the last press conference. Jay Powell will be doing a press conference tomorrow. We'll obviously watch it very quickly. And they also have the dots, the famous dots. This is where all the regional reserve bank presidents and the members of the Board of Governors all get to do their little unemployment and interest rate inflation forecast for the next over a year in advance. They're always wrong, but they do it anyway, and the media loves it and gets a lot of press. But so we'll have dots and a press conference tomorrow. I can tell you what the Fed's going to do. They're going to do nothing. They're not going to raise rates. They're not going to cut rates. They're not even going to offer a lot of guidance. Powell will do the usual, keep his options open. He's not going to say that we're absolutely not going to raise rates. He's going to leave the door open to a rate hike just in case inflation doesn't come down the way they expect. We'll get more inflation data next or later this week and next week. But that's very different from signaling a rate hike. He's not going to do, he's going to leave the door open, but the signaling is going to be all about the pause. They think they're at the terminal rate. They think they don't have to do more. They think inflation will not come down on its own based on what they've already done. They don't have to raise rates more to bring inflation down. That's their definition of the terminal rate. Completely made up concept, by the way. But if you're analyzing the Fed, you got to think about things the way they do. So I expect a really boring press conference. Nothing of substance, no rate hike, no rate cut, no real indication, no reason to think they're going to hike rates early in 2024 at all, but they're not going to give any ground on rate cuts. And this is probably the most interesting part of it, where the market is betting, yeah, they're done raising rates. Everyone agrees on that. So now the betting is, when are they going to cut rates? And Wall Street thinks sooner rather than later, maybe as early as February or March. And what the Fed has been signaling there is, we'll get around to it when we feel like it, but we're not in a hurry. Since rate hikes are still on the table, even though they're not going to hike rates, they can't be too eager to talk about rate cuts. And what Powell said at the last meeting, and I expect him to repeat this tomorrow, is, you know what, we're not even talking about that. In the FOMC, we're not even discussing rate cuts. Will they happen someday? Yeah, probably, but we don't know when, and it's not on our agenda. So you're going to have this world where the market is sort of expecting rate cuts in, February, March, if not sooner, and the Fed's telling you, no way, that maybe late 2024, but we'll get around to it when we get around to it. It's not on the table right now. That's not to say the Fed won't cut rates. I think the Fed will cut rates sooner than later, not because they expect it, not because they want to, but because of the recession we just talked about. Remember, the Fed has one of the worst forecasting records of any institution. So the Fed's not forecasting recession. They never forecast a recession. Have you ever heard a Fed chairman say, well, by the way, we're expecting recession in the next 30 days? I mean, if you're in one and it's bad, they'll talk about it. They'll talk about, we got to cut rates to get out of the recession. But they never forecast it, and they never see it coming. So it's just not on their radar screen. But my analysis is that we're in a recession already. There are other analysts who agree with that. And if you think that's right, and I do, then they will cut rates, not because they think they will now, but because they're going to be forced to as the recession gets bad enough. But having said that, the Fed does not turn on a dime. They do not flip policy based on 1 month's data or one bad headline or one higher unemployment rate. And of course, we just had the November unemployment report last Friday, a couple of days ago, and it was strong. It was, 199,000 jobs created. Unemployment rate dropped. And so that's not the kind of employment report that gets the Fed to cut rates, because you still have a little inflationary potential built in there. Now you have to parse that a little bit. 199,000 jobs, yeah, that was above expectations, but about 55,000 of those jobs were the United Auto Workers coming back to work after the strikes at, I believe, Ford and General Motors. I don't know if they struck Chrysler, I think it's called Stellantis or something. Um, but certainly Ford and General Motors. So those workers coming back after the strike counted as new job creation, but they were really just old jobs that went on strike and then went back to work. So that's not really a sign of strength. It's just a statistical quirk. And then there were another, I believe it was 70,000 jobs or so that were government jobs. Okay, job's a job. You get a paycheck. I guess you spend money, but that's not exactly a robust private sector. That's not, manufacturing or service economy or retail or anything else getting stronger. That's just the government hiring people. And then there'll be another surge in December because Amazon hires a zillion people to ship packages and then lays them all off in January, et cetera. Um, so there was less, I'm not denying the report. It was strong. It's strong enough to keep the Fed from from cutting rates, but it is a little bit less there than meets the eye in terms of a strong economy. But uh, so the Fed's really kind of irrelevant, at least for the time being. Does a 25 basis point hike or cut in short-term, like overnight interest rates, the Fed funds rate, which is what they control, does that save the economy or sink the economy? No, it's just not that important. What is important is the economy. The economy is much, it's not that the Fed leads the economy. That never happens. The Fed trails the economy every single time. The economy leads the Fed. The Fed doesn't control the economy. They tweak it, they work around the edges, et cetera. But they really can't uh, do anything. The whole idea of stimulus. I mean, they printed about $10 trillion of base money between 2009 and 2019. What was average annual growth over that 10-year period? 2.1%. Where was the 3% or the 4% growth if somehow that was stimulative? The answer is it wasn't. So that won't change. So I wouldn't. Do we follow the Fed? Yes. We're going to send out reports on. Yeah, we'll be there. We'll be watching the press conference, and we'll give you our view, although I already told you what's going to happen tomorrow because we know. But I would focus much more on the economy and some of the signals and some of the data that we discussed a little bit earlier on the call, rather than what the Fed does.
Yeah, as you just said, the economy leads the Fed. Seems like they're reactive instead of proactive in that respect. And readers, those of you who have Jim's Crisis Trader publication, Jim will continue to give his ongoing commentary on Fed policy in that publication and how it impacts markets. And I'm sure he'll continue any developments in any further developments in monetary policy, including his analysis in the weekly 5 links as well. Jim, let's turn to another topic and get your take on it. And it may tie into a recessionary period as well, and that is gold. Many of our readers are interested in where gold prices go from here. We have a lot of positions in our portfolio that are impacted by the gold price. We're just coming out of a month where we saw gold close above the $2,000 price level ever. Do you see $2,000 as the new floor for gold and moving up from there? And what catalyst do you see that will continue this bull market for gold?
Well, I guess I've been kind of negative on the economy, but I'm actually very positive on gold for some of the reasons you mentioned. Yeah, it's gold. Just to kind of recap what's happened over the last couple of weeks. Gold blew through $2,000 an ounce. That was always, it's been above $2,000 an ounce multiple times in the past, but it wasn't able to hold that level and fell back at different levels. Sometimes not that long ago, it was as low as in the low 1700s. But made its way back to 2000. But then it just went like a rocket past 2100 and got to a new all-time high of about $2,180 an ounce. Now, that was an intraday high. That was not the closing price. So if you're looking at a chart based on closing prices, you won't see that little mini spike. But I was watching the ticker, and if on an intraday basis, it did get to 2180, which was nice. I mean, that was, I guess, a new all-time high. It's fallen back a little bit since then. It's around 2030, normal volatility. It's been kind of flattish the last week or so around the 2030, 2040 level. But that's healthy also because it means that the 2100 level, which it hit recently, was not a fluke, and that, it does look like 2000 or 2020 somewhere in there is a floor. So, but in terms of forecasting the price of gold, you have to ask yourself, well, what's driving it? First of all, figure out what the drivers are, what the explanatory variables are, and then ask yourself the second question, which is, are those going to continue, or are they going to reverse, sustainable or non-sustainable? So when you go through the factors, one of them is obviously output, how much, supply and demand, right? So let's talk about supply. Output has been flat for about 6 years. It's not collapsing, but it's not spiking. I mean, gold, I have a couple of gold mining investments and I follow the area closely. It's getting harder and harder to find. There are some, significant new discoveries, but other, mines are depleted or shutting down. So on net, uh, output has been pretty flat. So, and that's constant. Like I said, it's been true for over 6 years. So you can't account for the gold price strength based on supply. If supply collapses, like, yeah, okay, let's bid up the price to $4,000 an ounce or whatever. But supply is kind of flat, so that doesn't tell us very much. Central bank buying is important, but that has also been true for a while. The inflection point was 2010. So from 1970 or even earlier to 2010, period of about 40 years, central banks were net sellers of gold. The US sold 1,000 tons in the 70s. UK sold more than half its gold, around 300 or 400 tons in the late 90s. I'm sure they got pressured by the United States, but they did. Switzerland sold 1,000 tons between in the early 2000s. Again, by the way, there are some technical reasons, legal reasons, why the U.S. won't sell any more gold. If you think it's worthless, if you don't think it's money, if the price is attractive, why wouldn't you sell some gold and, balance your budget deficit, or at least have some more spending money if you're the U.S. Treasury? Well, the answer is that when the Treasury confiscated the gold from the Fed, the Federal Reserve, it's kind of like the banks took it from the people, the Federal Reserve took it from the banks, and then the final act was the Treasury took it from the Fed. And so the Treasury actually owns the gold, even though I always say the Army owns it because it's on Fort Knox and West Point. But under the U.S. Constitution, remember, the Fed is a private, pardon me, it's owned privately, but it's owned by the banks in the system. Excuse me. So under the Fifth Amendment of the U.S. Constitution, you can't seize private property without paying just compensation. So when the Treasury took the gold from the Fed, they had to pay them something, and they did. They gave them a certificate. This is the gold certificate from the U.S. Treasury, and the Fed still has it on their books. And by the way, they value it at about $42 an ounce. Well, at over $2,000 an ounce, obviously on a mark-to-market basis, there's a big unrealized gain on the books of the Fed. The Fed's insolvent by some measures, but when you do that math, you have to give them credit for the unrealized appreciation in the gold, which is about $400 billion. So the Fed has $400 billion of hidden capital, not on the balance sheet, in the form of the gold certificate that's not marked to market. But where's the gold backing the gold certificate? Well, it equates, so when you do the math and look at the Fed balance sheet, it's about 8,000 tons, which is how much gold the U.S. Treasury has. So my view, no one's ever articulated this, but using a lot of legal analysis and economic analysis, it looks like the Treasury can't sell any gold without violating the gold base backing the Fed's gold certificate. And that would explain why why the Treasury hasn't actually sold any gold since 1980, because that's about the time they hit that level. So we got the Brits to do it in the 90s. We got the Swiss to do it in the early 2000s. As late as 2010, I believe, the IMF sold 400 tons of gold. They never revealed who they sold it to. Looks like about half went to India and a few other countries, and then I'm guessing half went to China. And I don't have that. I can't confirm that, but that they didn't disclose it, and that would be a logical place. But then it ended. All those gold sales I described, and I just talked about on to about 3,000 tons of gold, and there was more over that 30-year period, stopped cold in 2010, and central banks became net buyers. Who's buying? Russia, China, Kazakhstan, Vietnam, Mexico, Turkey, Iran. Some are more transparent than others, but there have been huge buyers, and there continue to be huge buyers of gold from the central banking community. But in terms of price forecasting, again, that doesn't carry much weight because it's been true for a while. It's been true for 13 years at this point. So it's a powerful force, but it's not a new force. So by itself, it doesn't account for why gold spiked all of a sudden. So supply is constant. Central bank demand is going up, but pretty constant, not new. So what is new? The first thing that's new is a sharp decline in interest rates. And here I'm looking at the yield to maturity on the 10-year Treasury note, which is a pretty, it's an important security in and of itself, but it's a pretty good proxy for uh, it's a pretty good proxy for long-term investing. So the average mortgage is about 7 years. You have a 30-year mortgage, but most people, on average, they move every 7 years or so. So the weighted average maturity of the mortgage-backed securities market is about 7 years. When large corporations do long-term investing plans, capital investment at the board level, et cetera. They think in terms of 5 to 10 year programs. They're not like day traders. So the 10-year Treasury note is a good proxy for fixed asset investment and commercial real estate mortgages, which is a big part of the economy. That has crashed. That rate was as recently as 5, 6 weeks ago was 5%. Today it's around 4%. If you say, gee, 5%, 4%, what's the big deal? 1 percentage point. No, in the bond market, that is an earthquake. You don't move 100 basis points in yield in a couple of weeks. That's almost unheard of, but that's exactly what just happened. By the way, we're talking about gold, but we've recommended U.S. Treasury notes for a long time in our portfolios, and they just had huge capital gains. When interest rates drop from 5 to 4 on a 10-year note, you're looking at 20% capital gains in a couple of weeks. Again, that was long been one of our recommendations, but if you follow that, you just had a huge profit on those notes. But every indication that it's going to fall even more because 4% interest rates are sky high relative to what happens in a recession. I would expect the 10-year Treasury note to come down to 3, and then even maybe 2, 2.7, 2.8, who knows where, so somewhere in that zone. That's 2.5% yield to maturity on a 10-year note is consistent with what you see in a recession where GDP is declining and unemployment is skyrocketing. It could go even more. But the point is, bond math 101, interest rates down, prices up. So the value of those notes has skyrocketed. And as I say, a rough estimate, capital gains, 20% or more just in recent history, and there'll be even more as the interest rates continue to come down. So that's an important market. But getting back to gold, gold has no yield. You can have big capital gains, you can have big capital losses. Certainly the price moves around and it can be volatile, but it doesn't have a yield, doesn't pay a coupon like a treasury note. But it competes with instruments that do have yields for investor dollars. So if you're an investor and you're doing allocation, I got so much to stocks and so much to private equity or so much in cash or whatever. And how many treasury notes do I want? Do I want 10 years, 5 years, 2 years? How much gold do I want? Well, the higher the interest rate, the less attractive gold looks. It's like, yeah, gold, I like gold, but I could be buying 5-year treasury notes and they'll pay me, 4.5%. That looks pretty attractive. And if it goes down more, you get capital gains. But the more the interest rate falls, the lower the opportunity cost. In other words, gold looks relatively more attractive in a world where interest rates are falling because you're giving up less to own the gold. And of course, once you own the gold, you can participate in the rally. So I would say interest rate declines are a major factor. Beyond that, you get into momentum. There are people who they don't care if it's gold, soybeans, or coffee beans. I mean, they just want to get on a trend. So this is where the hedge funds jump in a little bit. And then, of course, there is the geopolitical landscape. We haven't really talked about that on this call, but a war in Ukraine, a war in the Gaza Strip between Israel and Hamas, possible escalation in both places. In the Middle East in particular, it could escalate to include Iran, and Russia comes in and backs Iran, and then you're one step removed from nuclear war, basically, certainly World War III. Pretty good reason to own gold. I'm not saying those things are going to happen. I'm saying that they could happen, and they're much closer to happening than one would like, certainly. And you need some hedges for that. I don't even want to think about where the stock market would be if somebody set off a nuclear bomb, but I do know I'd like some gold in that world. So I think the geopolitical landscape, the declining interest rate environment, and the uncertainty that comes in with recession are all really good reasons to fill up your allocation with gold. We've always recommended 10% of your investable assets. If you like, seasoned to taste, if you want 5%, okay. If you buy 5%, you'll be 5% more than most people because most people don't have any. Most institutions don't have any. Even 2%, is more than zero, but I would recommend some allocation of that magnitude given everything we just discussed.
Okay, very good. Um, Jim, another topic our readers, I'm sure, are concerned about, we've gotten some questions on, is how about the energy sector? A lot of readers want to know how bad this winter is going to be for energy prices, or what your thoughts are on any energy shortages in Europe. I know they didn't get them last year because it was a milder than usual winter, but how will energy shortages in Europe impact markets, and how will it impact energy stocks?
Well, I'm very bullish on energy stocks. And when I say energy stocks, just to be clear, I'm talking about the major oil companies, but they're pretty big in natural gas as well. So we'd be talking about Chevron, ExxonMobil, in particular alike, and there are others out there. Marathon. Actually, Marathon is interesting because they have more refining capacity than some of the other oil majors. But I like all of those. The And in my view, it's a win-win situation. Let me explain what I mean by that. Clearly, if oil prices spike, to 125, $150 a barrel, $200 a barrel, that would produce major windfalls for these companies. And obviously, greatly, greatly increase their stock prices along the way. Now, I just got done talking about recession and disinflation and declining prices and all that. And the price of oil has come down recently. It wasn't that long ago. It was flirting with kind of $90 a barrel. Then it was trading in the mid 80s. And then all of a sudden it went into the 70s. And just a few days ago, it was kind of $69 a barrel. Well, that's all consistent with the recession scenario that we described. It's not, there's no supply disruption, except to the extent that Saudi Arabia has cut their output. They could increase it in a heartbeat, but they've cut their output to try to prop up the prices. The decline in oil prices is coming from the demand side. Again, consistent with recession. Now, gasoline at the pump, for example, it's very inelastic. Inelastic is one of those $5 words from economics. So what it means is that you buy it no matter what the price is. You just need it. So food and gasoline prices tend to be inelastic. You pay whatever you have to pay because you need it. You have to eat. You got to get to work. You got to take the kids to school. As the case may be. But inelasticity is not indefinite. People will cut back when they're under a lot of stress. And I described a situation where they are under a lot of stress. Savings are going, credit cards are maxed out, I know we had a strong employment report, relatively speaking, last Friday, but I expect unemployment is, by the way, a lagging indicator. You don't see the unemployment spike until you're already in the recession. It's like the last thing to go. A lot of other things are cut back on or reduced, or costs are reduced, contracts renegotiated, rent renegotiated, et cetera, before employers get around to firing people because they don't want to. Labor is scarce, and they hire them and train them, and they don't want to let them go. But they will at the end of the day if the economy gets bad enough. We're getting to that stage. So with all that going on, people are driving less. I mean, maybe you got to fill up your tank to take the kids to school, but you don't have to go on a cross-country trip. You don't have to drive 7 hours to visit, your grandmother or some distant relative or whatever, or take a vacation. Those are the kinds of things that get cut out of budgets pretty quickly. The consumer discretionary items, food, gasoline, rent, home heating are necessities. Vacations, trips, um, concerts, theaters, Taylor Swift shows, those are not necessities. Those are the things that get cut out when times are hard. And they will affect gasoline prices and oil prices. It's not that you stop driving completely, but you might stop driving, a third or more. And so that's what's bringing the price of oil down. Now, having said that, why would we even consider oil prices going to, let's say, $150 a barrel or higher? Well, the answer obviously is the war in the Middle East. It's already escalating. Israel is, pummeling Hamas, obviously. But Hezbollah is stirring some trouble on the northern border of Israel. Hezbollah is different than Hamas. They're based in southern Lebanon, which shares the border with northern Israel. They've been firing missiles. We have the Houthis. Who are the Houthis? They're Islamic fundamentalists conducting a rebellion in Yemen, 100% backed by Iran. The Hezbollah is backed by Iran. These are all, in different ways, these are all Iranian proxies. So what they're trying to do is attack Israel from all sides. If you can engage Israel in a war in Gaza, attack from the north from Hezbollah, attack from certain bases in Syria and Iraq, and then fire drones and missiles from Yemen with the Houthis, you're coming at Israel in all directions. And again, it's all backed by Iran. Well, how long does that go on before somebody whacks Iran? And Ronald Reagan practically sank the Iranian Navy back in the 1980s. Um, and then the other day, there was a Houthi attack where they were firing drones and missiles, but there was a U.S., I believe it was a destroyer in the Persian Gulf, in the Red Sea, not the Persian Gulf, but in the Red Sea. And these missiles were coming their way, and it wasn't clear, are they just missiles heading for Israel and they're flying overhead, or they're heading for us, heading for that vessel, in other words. But they were shot down. But that would clearly be regarded as a Houthi attack on the U.S. Navy. That's an act of war. So what did Biden do? I mean, Biden's like the most, kind of brain dead, feckless commander in chief we've ever had. He attacked some Iranian bases in Iraq. All right, well, why are you attacking bases in Iraq? Why aren't you attacking the Houthis? By the way, one of the first official acts Biden did after he was inaugurated in January 2021, he removed the Houthis from the list of terrorist actors who are subject to sanctions and other punishments and retribution just by being on that terrorist list. He took the Houthis off the terrorist list, and yet they're firing drones at the U.S. Navy. Makes no sense, but more to the point, why don't you attack the Houthis if you want to, put them out of business? They're the ones firing the missile. So I can't account for the incompetence of the White House, sort of speaks for itself. But I do know that all it would take is one hit on one naval vessel or one decision by Israel or the U.S. Navy to take the fight to Iran itself, because they're the ones backing all the attacks on Israel, to, shut the Straits of Hormuz or send the price of oil to $150, $200 a barrel. That's not inconsistent with a recessionary, deflationary scenario. In fact, it happened in the 1970s. We had 3 recessions between 1974 and 1982. It was one in 1974, one in 1980, another one that began in 1981 and then got very severe in 1982. So three recessions in 8 years. Two of them were the worst since the Great Depression. One outdid the other. And unemployment went up to 10%, and there were all the signs of recession. But the price of oil went up by a factor of 8. I mean, it went up 4 times in 1974 and then doubled again in 1979. So the idea that you can't have oil price increases in a recession is not true. You can have a severe recession and disinflation, high unemployment, and oil prices can still double because of geopolitical disruption and fights with, well, mainly Iran, and certainly if the Arabs want to do another oil embargo, but they're kind of doing that, not in the hostile sense, but just by cutting output, they're propping up the price. Now, getting back to the oil stocks, clearly with a price spike for geopolitical reasons along the lines I just described, which is not inconsistent with a recession, those stocks would do very well. But I make the point that even in a world of declining oil prices, the major oil companies will do well also because their costs are declining. The thing about recession, it doesn't just affect the price of the pump, it affects the price of labor, interest rates, capital costs, transportation costs, and a lot of other factors that go into the ultimate price of oil. So for Chevron and Exxon, first of all, they're pretty good at hedging. But even if oil prices went down, if their costs are going down faster, that means their margins are going up. And if you apply a multiple to that, you can get a higher stock price. So I view those companies as in a win-win situation where it's not a pure function of oil prices. They can win in both states of the world, higher oil prices or lower oil prices, in a world where lower oil prices are the result of a recession, which lowers other costs as well. So I do like that sector. And I also think this is, we're now maybe over the hump of the curve in terms of the fanaticism of the green news scam, as I call it. It's really falling apart very quickly. John Kerry and his, Davy Crockett wig and all that. I mean, they're all out there banging the drum about, global warming and hurricanes and tornadoes and wildfires and CO2. It's all nonsense. When I say nonsense, the science backs up what I just said. Hurricanes are not more severe. The worst decade for hurricanes was in decades were in the 1930s and 1940s. Tornadoes are not more frequent. Blizzards are not more frequent. Wildfires, same thing. They're bad ones. Yeah, they happen. They happen all the time, but they always have. I mean, going back hundreds of thousands of years, or as far back as they can take some of these records based on, ice cores and tree rings and rock samples and other empirical data. So it's not that hurricanes don't happen. Of course they do. But it has nothing to do with global warming as defined, or absolutely nothing to do with CO2 emissions. I mean, the ocean levels are rising about 7 inches every 100 years. That's barely enough to get your feet wet. But the point is, whatever you think of that, they were rising at 7 inches per 100 years in the 1890s. I mean, before the invention of the automobile. So the point is, it has nothing to do with CO2. There is such a thing as climate change. Of course there is. I mean, the Vikings were growing grapes in Greenland. That's why they called it Greenland in the 10th century AD. There was something called the Little Ice Age in the 17th century in Europe, where you didn't need a bridge to cross the Thames River in London. You could just walk on the ice because it was frozen solid. So those kinds of warming periods, there's one in the Roman Empire, one during the medieval period, were cooling periods, such as the Little Ice Age in the 16th, 17th, and 18th centuries in Europe. They do happen, but they have nothing to do with CO2, nothing to do with automobiles, nothing to do with humans. They're caused by solar cycles, volcanoes, ocean currents, subduction, and the biggest factor of all that's been clearly identified that the climate geeks don't talk about, the experts do, the real experts, is are clouds. Basically, water moisture in the air, call it a cloud, that can shut out sunlight, that can trap heat or cool down certain sections depending on the season and time of the year. That's what drives climate, not CO2 and not all these other things that the greenies or the scammers are talking about. But my point being, they've kind of ruled the roost for certainly the last 5 years and maybe 10 years, depending on how you want to measure it. They're being very widely discredited. They keep banging the drum. They got this big thing in Dubai going on now, the 80,000 people there, et cetera. The Financial Times is all in. Jillian Tett has got her pom-poms on. She's a big cheerleader for this nonsense. But but the science is now catching up with the reality. And what's happening is they're being completely discredited, and more voices are coming out. That's going to favor the energy majors because it's going to be clear, should be already, but it's going to be clear. We are not getting away from oil. We are not getting away from natural gas. They do not cause climate change. They're actually very efficient forms of energy. I don't know how we're going to get along without them. You cannot run a modern power grid on solar and windmills. I'm not saying solar and windmills can't generate electricity. They can, but they do it on a very intermittent basis. I own one of the largest solar fields in New England. I built it myself, with a contractor, but we built it on our property, and it works fine, except at night. There's no electricity because the sun's not shining, and we get a lot of snow in New England, and you can't get much electricity on a snowy day. You don't really run on solar power. You run on batteries, and then the solar power charges the batteries. So when it's raining or at nighttime, you run the house off of the batteries and just don't run the washing machine, the dishwasher, and the hairdryer all at once in the middle of the night. That's dumb because you're using up your batteries. Wait for a sunny day. There's plenty of electricity. Use it or lose it. It works fine for a house. Not sure how you're going to run a modern industrial world's largest economy power grid on solar. The answer, well, I'm sure the answer is you can't do it. So I think the tide has turned. The Green New Scam is being discredited or shown to be a scam. Um, and the oil majors who have suffered and been beaten up over this, are going to come back strong. And then certainly if there's a geopolitical disruption, they'll be even stronger.
Okay, the Green New Scam is another reason to be bullish on oil stocks. By the way, Jim, we already have one complaint. My niece just called and said a Taylor Swift concert is a necessary expense, not
Got it.
discretionary.
Okay, is Uncle Frank paying for it, or that's the question.
I don't make enough to pay for one of her concerts. One more topic, Jim. I just wanted to squeeze in real quick before we close. And I don't think this gets enough airtime. It should, but you are one of the few analysts that keep sounding the alarm about it, and deservedly so. And that's another stage in this banking crisis. What do you see happening there? Can we see more contagion going on even in the last few weeks of this year, or in 2024?
Yeah, the answer is yes. So we had the crisis. Stage one ran from March to pretty much March 9th to May 1st, 2023. We had 5 major failures. Silvergate Bank, Silicon Valley Bank, which is different, Signature Bank, First Republic, Credit Suisse. Credit Suisse is one of the biggest, oldest banks in the world. Failed, entered into a shotgun marriage with UBS. That's a lot of bank failure in a short period of time. And don't underestimate the policy response. They basically ignored the FDIC insurance limits and guaranteed every deposit in the banking system. And in the case of First Republic, that was they only had about 3% insured deposits. Round numbers, about $140 billion in deposits, of which only about 3% were insured, meaning you had 135 odd billion of uninsured deposits, and the FDIC guaranteed every penny of it. The problem with that is like, okay, thanks. Where does that end? And Janet Yellen could not give a satisfactory definition. She said, well, we'll only do it for systemically important banks. I go, what's that mean? What is that definition? I would argue that the smallest bank in the country could cause the biggest financial collapse because of contagion. Just if this bank's failing, well, my bank must be failing too, better get my money out. And it just spreads very quickly. It's just like a virus, by the way. The math of viral contagion or COVID or whatever is the same as the math of financial panic, different inputs, but the equations are the same. You pretty much guaranteed every bank deposit in the country, and then the Fed said, we will buy, if you're a member bank, we will buy all your treasury securities at par, even if they're worth 20 or 30% less. So you could have a bond portfolio that was worth, $700 million. They'll give you $1 billion for the $700 million portfolio. So that's nice. You can't lose money in bonds because they'll just send them to the Fed. Sorry, busy day. Um, so the point being, once you've guaranteed every bond in the system and guaranteed every deposit in the system, what's left to guarantee? Not much. So when stage two of this breaks out, and it's coming, they don't have any more rabbits to pull out of the hat. There's nothing else they can guarantee because they already guaranteed everything. I mean, every treasury security and every deposit. What are they supposed to do? Say, hey, people, don't worry, calm down. So the question is that coming, and the answer is yes, because the stresses that I talked about earlier, some of them are very technical, and we can't get into them in great depth. But negative swap spreads, inverted yield curves, treasury yields to maturity that are below what the Fed would give you for free for a phone call. Like, why would I bid aggressively for security that pays me less than the Fed will give me if I just call them up and tell them to lend me the money? The answer is because you're desperate for the collateral. You want the bill. You can't rehypothecate the bills that you get from the Fed, but you can rehypothecate a bill that you buy at auction, and that explains why the yields maturity at auction are lower than what the Fed will give you, because people are desperate for the collateral, and there's a global dollar shortage. All those things are pointing straight to stage two of the banking crisis, which could happen any day.
Awesome. Fantastic